Good morning. It is Tuesday, August the 11th. Here's what's on the agenda. Oil holding gains as Trump makes sweeping new demands on Iran. Bonds fall, gold rallies above 4,400 with inflation in focus. And Nvidia partners with private credit in a $500 billion AI infrastructure push.
OK, Tom, let's talk about that Brent price. 88.01 is where we are right now. We're up by 0.3%. Doesn't look like the Strait of Hormuz is going to be opening anytime soon. Looks like the Trump administration is going to take the long road to that, i.e. pushing on the finance story rather than the kinetic story, I think probably is what we're watching there. Euro 50 futures doing absolutely nothing. We get back into the earnings season really tomorrow. Dollar yen is certainly one to watch out for. Japan may be closed today, but we're watching a return to that 160 level. How quickly can we get there? What kind of a narrative emerges if we do get there? That is the key question that we continue to watch, and what the unfolding story in Treasuries might look like will be really interesting. So lots to discuss this morning. The countdown to the opening trade starts right now.
Good morning. So another day and another about-face from President Trump when it comes to his position on Iran. New demands from the Iranian side, to the Iranian side, including compensation for what he describes as the deaths of tens of thousands of Iranian protesters. We're at a point now where both sides, Skylar and Guy, are essentially making claims and demands from the other side that will be seen by their counterparty as frankly ludicrous. So do we rethink the timeline? Is this now... There was consensus among many who come on this show that we will ultimately get a deal between the two sides. Is this the path to a deal, or is there a need for rethinking the fact that maybe this, what we're currently seeing right now, the friction around the Strait, that this is the status quo? And then how do we think about the implications for that, for the global economy, for inflation and for trade?
So if you're going to negotiate, do you go big and kind of, this is Trump's strategy, kind of push the envelope wider, put new things into the envelope that you're going to have to discuss? Is that the precursor to a deal? If both sides are kind of making big, extravagant, exorbitant claims of what they need, is that the kind of we're getting to the point at which a deal can be done? We've exhausted everything else. We're now at the maximal position, so therefore you're going to get a deal. Or is it we're so far apart we're never going to get a deal? I can't work out which one of those two things it is.
It feels very much like the we're not going to get a deal anytime soon bucket. And I think if you look at betting markets, that's the clearest sign, right? You know, there was a little bit of increased optimism last week, but you only had betting markets rise to 50% odds that you'd get a deal by the end of the year. We're only in August. That's still quite a lot of months of Hormuz closure. And I think now that's just lower. So
do we continue to push the oil price higher? Because that it's happened, but it's not like we're getting to 120 bucks a barrel. We're in the 90 level. But we're also exhausting the SPRs around the world. So at some point, when we all come back off our summer holidays, do we suddenly see it being pushed sharply to the upside, and then you get the big bond market reaction that comes off that?
I think right now it very much feels like fatigue from a market perspective. So if you look at open interest in calls and puts, that had surged in July, and it's come back down to like very normal levels within this crisis. So maybe people just don't want to position because you're getting whipsawed so much. It's the summer. You know, you're waiting for something more concrete. I will say, though, that the skew within the risk reversal call puts, calls are more expensive than puts. So people are still more worried about upside in oil prices than lower.
Dutch gas futures, Dutch gas prices, they jumped yesterday. Diesel prices were up about 10%. Year to date, European gas is up about 120%.
That felt a bit squeezy, didn't it? Clearly, there was a kind of repositioning. You don't get those kinds of moves on a normal day. So there was obviously a market reposition yesterday. But the fear going into, and we'll talk about this later in the show, the fear going into the winter is that Europe doesn't have enough diesel and Europe doesn't have enough gas. And that's going to be a problem because we need both of those two things. And if you're going to see the inflationary impact, the second, third round of fourth effects coming off that could be quite significant.
I mean, absolutely. I think generally within Europe, people have gotten more optimistic, but the worry is very much as you head into winter. And I think more broadly within assets, what we've seen overnight is that oil market move feeding into equities differently than bonds. So within equities, you know, they've held up quite well. I think in the U.S. session, it was a relatively boring earnings session, actually. But you're still seeing that pressure on bonds because of the worry within the inflation outlook. The other interesting dynamic that we've had that's changed is that gold is now rallying with oil. Now, some of that could be the fact that we did have lower yields, we had lower dollar on the NFP print, but it continued yesterday. And so, is that a change in relationship where people are thinking inflation is going to come down and maybe it's a different reaction function in yields and the dollar than it is in gold than it was previously?
Or is it China? Because we've seen ETFs, gold-backed ETFs in China, adding in terms of inflows. We've even seen reporting that the PBOC itself is starting to buy gold again. So how much of it is China? How much of it is a rethinking about the Fed? And does this get blown off course if CPI comes in hotter tomorrow and reinvigorates bets around the Fed, of course, that had been taken off at the back of end of last week on the jobs data?
I can't work out if I'm more excited about CPI or the 30-year auction that comes later in the week. How much is the US going to have to pay for long-term debt? I appreciate that it's not doing a lot of financing that far out, but we're north of 5%.
And it's a more interesting debate now because you bring in the intervention in terms of if you have higher yields, and we know that we're getting a weaker yen throughout this week unless we get some kind of intervention or we get a surprise from CPI. And so, does that mean you get some kind of reaction in the yen when you have those higher yields? Okay, let's talk about the other kind of debt-related story, and that's what's happening with AI. There's a couple of stories that really stand out, one of which is Intel raising a bunch of money. Equity money. Yeah,
20 billion, about 20 billion.
Well, it's getting scaled up, right? Yeah. We continue to watch that one. And then you wonder who's next. So who else is going to raise equity? Because credit's starting to get a little expensive. So there's been a lot of debt financing. And then you come back to this story that Jensen's been pushing over the last 24 hours. He's basically corralled everybody around a nice round table to talk about how private equity and private credit are going to be involved in financing this stuff, which sounds excellent for Nvidia. You guys finance it. Yep. And then you can buy my chips, and it's going to be great for me. So, Jensen, thank you very much. Very nice. So, you guys come in. It's nice to see you. But you look at Nvidia's CDS, it's just going up and up and up. I appreciate the hyperscalers are rolling over. But we're in a situation now where just more and more debt's getting piled into this trade, and the credit market is sounding worried. Equity's not there yet. But credit's starting to sound pretty nervous. It
also just feels like an everything trade now in a way that we haven't had recently. And that, yes, tech is a big weight of equities, and we've all known that. But it's a big weight in the U.S. It's a big weight in EM now, and now it's becoming a big weight in credit. So when the tech trade does eventually turn, you're starting to worry about markets more broadly. Yeah, the links are going to be. Debt usually is where the problem lies. Yeah. Generally.
Jensen Huang is describing this as an asset class, an investable asset class, the GPU. And so we were having discussion this morning about whether or not that can be classed as an asset class.
Is it? No, he thinks it's infrastructure.
Yes.
Infrastructure, I think, of lasting for kind of quite a long time. How long does a GPU last? And I'm also assuming that private equity comes in. They have a financing timeline that's 7 years, 10 years. How long does a GPU last? How long does it last? I'm assuming it depreciates quite quickly. And it will have some value at the end of that period, but how much, I don't know.
I'm hearing from people in the sector saying that they're still getting value out of H200s, that those, in fact, values have gone up. The cost and the price of H200s has gone up because if you're at the coalface of this technology, if you're Jensen Huang, what you're seeing is just incredible demand for GPS across the spectrum, and that there are clients out there and customers out there who can't get hold of them. There just isn't enough supply. That's what you're seeing. And so you're bringing together the big beasts. Yeah,
but does that go on forever? But that assumes that this goes on forever.
And it assumes we're going to be in a world of increased demand for intelligence across sectors, across countries, across regions.
So the AI build-out just continues at its current pace. This incredible ramp-up just continues to the sky and goes on forever. Because if it doesn't, then the arithmetic might look a little bit more tricky. I don't know. Anyway, got lots of great guests to talk about this on the show. We'll talk about fixed income. Marie-Anne Allier is going to be joining us from Carmignac. We'll get her take on the fixed income story. Benedict Lowe, BNP Paribas Markets 360 equities derivatives strategist for Europe, joining us a little bit later. And we'll talk about kind of what is happening in copper, what's happening in aluminium. If the Gulf stays closed, which metals get affected? Eva Manthi, ING commodity strategist, here a little bit later to talk about those stories, Tom.
Here's what else we are watching throughout the day then. Swiss Parliamentary Committee's recommendations on proposed tougher capital rules for UBS. An important point in that, of course, debate. 11 a.m. UK time, US NFIB Small Business Optimism survey. We'll get the details on that. At 1:30 p.m. UK time, Hungary's Parliament votes to select its new president. And US primary elections will be taking place in Connecticut, Minnesota, Vermont and Wisconsin. And on the earnings front, we get CoreWeave on the infrastructure side, the data center side, and Supermicro Computer as well. Of course, also part of that infrastructure play. It's going to be interesting. NASDAQ futures are called higher partly as a result of this Nvidia story. So well see if there's a read across to European.
Is it the Nvidia story or the Intel story?
Stories. Possibly. Well, Intel was a bit of a surprise. You saw the SOX.
Yesterday
So
down,
the SOX was down about between 2 and 3% by the close. The semiconductor index. As a result of the Intel story was the read.
So do you bounce off that, which is why NASDAQ futures are higher this morning?
Possibly.
Maybe bad day, you get a slightly better day. The UBS story is interesting. Sergio Mossi, I think, is going to be paying a great deal of attention to what happens here. The Swiss authorities and the SNB now say that UBS has enough capital to cover effectively what the Swiss government is going to be requiring it to do in terms of its new capital structure that they want. UBS, Sergio, is like, no, we don't. We're miles off that. So today's a really key day for UBS shareholders because I think what they'll do is they'll get some clarity today, maybe some clarity on what future capital returns are going to look like. Because if you can get clarity on what the capital story is going to look like, you can then start to extrapolate in terms of what UBS is going to be able to do in terms of its capital returns to shareholders. It used to be probably one of the best bank, if not one of the top banks in terms of capital returns. Obviously, as a result of Credit Suisse and these new capital requirement stories, that changed. Do we now get back to a better capital return story
and
from
our
UBS?
reporting is suggesting we may not get complete clarity
until
the end of the year. But this is an important committee in the upper house in Bern that's going to be making potentially this decision today.
Anyway, what have we got coming up? We're going to talk about what is happening with the UK consumer story. Apparently, it's too hot to shop. That is the latest read. We're out there buying maybe a few essentials, a few luxuries, but the summer heat is keeping us from shopping. The UK shopping report's basically a weather report, but in the rearview mirror. Plus, German auto giants are losing sales in China. Homegrown electric vehicles are certainly pushing them very hard. We're going to have more on what this means for the German auto market. Jane Foley's going to be joining us shortly. We'll talk about the dollar. We'll talk about the yen. You got any questions? We would love to hear from you. Please send us your thoughts. Join the conversation. Round the table. IB Plus, BBTV Go is the function on your Bloomberg terminal. We're looking forward to hearing from you. This is Bloomberg.
Back to the subject of Iran, sir. Can you give us any estimate of when you think the Strait of Hormuz will be part of
it's open now. We're taking a lot of ships. It's open now. Look, the only one that has control of the Strait of Hormuz right now is the United States Navy. We have a blockade that's been infallible. It's a steel wall. And we let people in that we want to let in, and those people come in, and they've been coming in and they're going out. So it's actually open now.
Bloomberg senior White House reporter Josh Wingrove questioning President Trump in the Oval Office. Oil, meanwhile, holding on to gains this morning after President Trump made sweeping new demands of Iran. The president is calling for Tehran to pay compensation for damage and deaths caused in conflicts across the Middle East. The demands come in response to Tehran's requests for reparations over the war. For more, let's bring in Bloomberg's Abir Abu Omar in Dubai. Abir, so both sides ramping it up in terms of the rhetoric at least. What are we seeing in terms of any signs of progress around the Strait? Is the president right to say that the US controls the Strait?
It's a good question, Tom. According to the Iranian side, no, he's not right. But when it comes to the deal and the prospects of reopening the Strait of Hormuz, we seem to be drifting from those prospects every single day. And this is what you're seeing reflecting in oil prices. So here are the 2 points. From Iran's perspective, essentially, the hardliners over the weekend have asked for some maximalist demands, if you were. Those include the lifting of the U.S. naval blockade on the Strait of Hormuz, a compensation for the damages occurred by the war. And then you also have them asking for the lifting of oil sanctions, the blocked assets. President Trump, in the latest remarks I do have just heard, had said that, well, if Iran is going to ask for that, the U.S. will also ask for compensation over the thousands killed over the past 50 years in Iran. He also said that Iran is responsible for deaths that happened in neighboring countries, including Yemen, Syria, Lebanon, and in Gaza. Now, he didn't give a lot of clarification on what exactly that means. But look, the hardening in the perspective of both sides of the table really puts this whole deal between Oman and Iran in the limelight, and just how near it is. The latest we know is that that deal is in the final stages of being reached. We don't have any further clarity on what exactly that would happen. That is what we have reported over the past 10 days or so. But for the time being, what is the most important is that those ships and vessels are still very much stuck in the Strait of Hormuz. And again, that is what you're seeing reflected in Brent crude edging very close to $90 on the barrel.
Yep, we'll continue to watch and continue to see that potentially tick higher. Abir, thank you very much indeed. Abir Abu Omar joining us out of Dubai. Let's talk about the FX implications of all of this. Jane Foley, Head of FX Strategy at Rabobank, joining us this morning around the table. Good morning.
Good morning.
If oil continues to go higher, bond yields presumably go higher, where does that show up most in FX?
Well, I mean, it shows up, I suppose, also in respect to the dollar. You've got the safe haven bid. So you've got inflation for everybody. And you could say, well, that's all tides have been lifted at the same time. But some currencies will also see the inflation risk more. And I think once we can talk about the dollar and we can talk about the Fed and we talk about CPI data, etc., I think what's quite interesting is to turn that and look at the euro. Because if you look at positioning with respect to the euro, they were pretty long right up until the start of the war, and then they crashed down. And the market is very reluctant to have long positions in the euro. And this is, of course, because we know that the Eurozone is an oil exporting region. We know that that has implications for its growth, for its inflation too. And I think this, if we do get a prolonged period of elevated oil prices from here on in, I think the euro is going to remain on the back foot. And again, that allows the dollar a little bit more traction, or allows it to get some traction back.
But the ECB just have to raise rates at that point?
Well, I mean, they already have raised interest rates. The market's expecting them to go again. We're talking, about monetary conditions, restrictive potentially for the ECB. We're sort of looking at that sort of language. And I think for many of the central banks, if this is more prolonged than perhaps the consensus is currently thinking, you would be talking about maybe another interest rate. Are we talking about that for the UK, for instance? Would we be talking about...
But growth would be the bigger concern.
So growth is a significant concern, I think, if we had interest rates go into more restrictive territory. Okay. And I don't think that's just for the Eurozone. I think that is for a number of different countries. I mean, you could talk about that for the UK. You could talk about that for the US too. We've already got a loosening of the labour market. We've got a loosening of the labour market in the UK. We have done for some time. So you're talking about, yes, interest rate hikes potentially because of the inflation implications. But what is that going to do to growth? And I think the euro would remain on the back foot in those sorts of circumstances.
So where is the balance of risks for the UK, for the pound then, in light of that weakening labour market but higher inflation impulse?
You see, I'm nervous about the pound because I think right now we've had this number of measures by the new Prime Minister that's meant to make us feel good. The cap of bus rides, £2 on bus rides. None of these are really going to make a huge amount of difference. So he's, I think, trying to make us feel better, maybe making us spend more, getting some of that savings down and using that to provide growth. But we know that there's a budget coming up on October the 28th. We know that in order to get his programme through, if he can't issue more gilts, then he's going to have to raise taxes. So we know that that's around the corner. I think the consumer is nervous. And at the same time, you've got a labour market, which, yes, it's showing signs of stabilisation over the last 2 months, but it has loosened. And I think people are wary still about that. And I think, yes, some of this feel-good can help to perhaps soften that over the summer. But I think going into the autumn, I think we could have this implication where when the market's concerned, is there going to be more supply? What's going to happen with respect to tax rises on growth? And I think, sterling could be quite disappointed, particularly if there is no interest rate hike.
Looking at the yen, I think we've had more hawkish pricing come in terms of October, looks pretty much fully priced. That could come to September, but it's not really supported the yen that significantly. Is a September hike enough to see appreciation, or do you need something bigger?
I would really like to say, oh, a September hike will be enough, but my gut feeling is they need more. There's an awful lot going on in Japan, a huge amount in terms of reforms, a huge amount, to try and make the stock market better regulated, for instance. The inflation, the fact that they have inflation, I mean, that's pretty exciting in terms of investment, because clearly, if you have disinflation, deflation, you invest a lot in cash. And so there's huge piles of cash which could go into assets, and it's making its way into assets. I think that's exciting for Japan. That's exciting, I think, for international investors looking for opportunities. They have a lot of supply chains with respect to semiconductors, and that too makes the country quite exciting. But the market is focused on two things, and one, of course, is the interest rate differential outlook, and the other is supply of JGBs. And of course, if you like, we were really exposed to JGBs in 2024 when we saw the end of QQE. And I think that has sort of unmasked this whole issue about the huge debt. And I think the market needs more reassurances on supply of JGBs along with a faster pace of interest rate hikes. And until we have real strong confidence in that, I think the yen's going to be a little bit more vulnerable.
So to be clear, so there's further weakness in store for the yen, unless those two things come together, both the BOJ and on the government side,
yes,
addressing the fiscal concerns.
Yes, and there are noises. We have had a number of reassurances from the government about supply of JGBs, but the market isn't hearing that. It doesn't want to hear that yet. It's not ready to hear that yet. I think we need bigger reassurances on that front. We need to get through the next budget. We need to see what that brings. We need to, really try and sense what's happening at more of these JGB auctions. And then, of course, we would maybe have a surprise, which would be a September interest rate hike. Now, those things together, I think, can really help the yen. But, that doesn't mean to say that we're not going to go back to 160 in the meantime and the market to try and pressure and test the water at that level. OK, 159.22 right now on the dollar yen. Jane Foley, thank you very much indeed, as ever, for your insights into the FX space. Rabobank's FX global head.
OK, what else do we need to know this Tuesday morning? At least 130 people are confirmed dead after a magnitude 7.4 earthquake struck Colombia yesterday. The quake toppled buildings and buried people under the rubble, including in the capital, Bogota. Significant damage was reported in the country's coffee heartland, the region immediately east of the epicenter. The number of casualties is likely to rise as rescue teams search for survivors. President Trump has offered his support to embattled FIFA president Gianni Infantino amid a growing revolt threatening his leadership. Trump said FIFA would be making a, quote, terrible mistake if it decided to replace the Swiss football boss. Infantino has faced criticism from dozens of members after his failed plan to spin off FIFA's commercial operations in a deal involving JP Morgan. And we talked about a little bit earlier on, British shoppers retreated during the July heatwave, prioritising small treats and cutting back elsewhere as the recent consumer boost showed signs of fading. According to the BRC, the British Retail Consortium, sales increased at an annual 1.3%, half the pace recorded earlier in the year. Food sales were boosted by England's World Cup run, but non-food sales fell for the first time since April. Apparently, it is too hot to shop.
Yes, and Europe, meanwhile, entering its fifth heat wave of the year. Is it two-thirds of the UK now
in drought?
In drought.
Yep.
So the soft commodity impact, you're seeing farmers having to harvest early, but yields are down, and that's not just in the UK, that's across the continent as well.
It's not good.
I mean, from an energy
the
impact
as well.
Yeah,
I mean, you've got both a supply and demand impact from this, right? In terms of you're getting greater demand for energy because you have hotter weather that needs AC, etc. But then on the supply side, you have the Danube drying up. It means you don't have as much power from nuclear, etc.
And gas prices at the same time are rocketing higher. So you've also got that factor to fold in from the Gulf too. So that's going to boost energy prices as well. Are we long Magnum ice cream? I think, is that the stock to watch at this point?
Short carrots, long Magnum ice cream.
Yeah, you're definitely getting short carrots
Johnson trade. Coming up ahead of key inflation data from the US, we're going to discuss positioning in fixed income with Carmignac's Marianne Elliott. That is coming up next. Stay with us for that conversation. This is Bloomberg.
Morning, Tuesday, the 11th of August. How are you doing? 30 minutes to go until the start of cash trading here in Europe. I'm watching US futures begin to roll over a little bit right now. They're not negative. Well, Nasdaq mini futures are not negative. S&P mini futures are now negative. But a few minutes ago, they were definitely significantly more positive, and we are now beginning to unwind that. Here in Europe, we've got a negative picture, not a massively negative picture. Looks a little like what we saw yesterday. Yesterday was a very quiet session, you could argue, for European equities. Are we going to see some more excitement today, or is all the action, Tom, in the bond market?
Well, we did see that sell-off in terms of US Treasuries yesterday with a 6 basis point move on the 10-year with yields up. Today, we are seeing a modest amount of selling very modest, across the European bond markets. You're seeing yields up about 1 basis point over in Germany. You can see the 10-year there closing in on 320. Just above 4% on the 10-year over in France. Yields up 2 basis points there. Similar picture over in Italy, closing in on 4% right now for BTPs, with yields up to 2 basis points. In an environment, of course, where you're seeing Brent at around $88 a barrel, up 0.7%. But we've had a number of days of gains on the geopolitics. It's once again oil in focus and inflation concerns. And you're seeing that impact in the bond market, Skylar.
Yeah, I mean, it really brings into question whether or not the data we're now getting is backward looking if we now have oil prices rising again. We get U.S. inflation later this week. We got non-farm payrolls on Friday. But if you look at price action in the 2-year in the U.S. today, we've completely undone the rally that happened on Friday on the fact that we have higher oil prices. And it means that you're increasingly seeing a floor in yields, I think, and your kind of fiscally vulnerable places are getting harder hit. Your UK, your France, you're seeing some widening there. And that's likely to continue to be the story until we see a greater resolution to U.S.-Iran.
Yeah.
What are you going to... The US 30 is going to the other end, 5.26. What do you need to do to get that away? You've got a big auction coming up later this week. How much are they going to? What are you going to demand? The US mortgage rates are pretty high right now. Does that continue to be a factor here as well? What does that mean for the US consumer as rates continue to tick higher and higher and higher? But as you say, big move yesterday in gilts as well. Big move yesterday in gilts. Gas prices are going up. All of that kind of stuff is going to feed through. Bank of England's going to have to pay attention to second round effects, as Jane was saying earlier. There's some significant moves here that are worth paying attention to, but equity's not quite yet ready to do that.
Well, let's get another take on this story then and bring in Marianne Alliot, fixed income fund manager at Carmignac, standing by patiently for us. Marianne, good morning. How much further pain do you expect to see in the bond markets on the back of higher oil prices, higher energy prices, gas, diesel, and what we're seeing in terms of the geopolitics of Iran?
Wow, what a lot of bad news for bond market. But I think a bit of that is already priced in when you look at, for the US, for example, we went from a 3 cut to 2 hikes or maybe a bit more. The same in Europe. So a part of this story is already priced in. The bad news, and I think we focus a lot on oil, gas, and the energy complex, is that food prices could be the next step of inflation in the market. And just before you were describing how, bad is the weather for harvest. We have the Russian, attacking the capacity of Ukraine to export grain to Europe and the rest of the world. And I think it will be the next supply shock will be on food. So no good news for central banks.
When do you see that? Yeah, when does the food inflation shock come through? And are you suggesting that isn't priced into the bond markets at this point?
No, I think what the bond market was expecting is that you have a rise in oil and gas and energy, but at least in a 1 year or 6 to 8 months, you will have negative base effect. So the inflation, it's a one supply shock, but you can look through because base effect will be negative in March, April next year. But we expect food to be in place end of the year, 6 to 8 months or 12 months from now. So they will replace probably the shock in energy prices and not allowing the negative base effect to play fully. So I don't think that is priced in the market. For the moment, the market is focused on, oil. And we can see that, just before you were speaking about oil, gas, energy, but very few people for the moment are looking to food. Even if you have a European Commission warns that harvest will be very low in Europe in the next 12 months, that we know El Nino will be another volatility element in the food prices. So a lot is not priced in this part of the market.
I do wonder, I think, the yield rise that we've had is in part because we've had hawkish communication from central banks. It might be a one-off supply shock, but are central banks reacting differently than they did previously because we've had so many supply shocks through the 2020s?
Yeah, exactly. Is that one supply shock you can go through, but when you have COVID, disruption in this supply chain, and then you have energy, and then you have food, I think the risk is that you have a de-anchoring of inflation expectation, and that's where the second round effect can take place, and that's where central banks are very, very attentive, at least in the UK, in Europe, when you look RBA or New Zealand, all these central banks are very, very cautious about the second round effect.
In terms of the curve, are we looking at an environment where central banks increasingly control the front end, but governments increasingly control the long end?
You could say that in the US, where, Scott Bessent made very clear that he didn't want to wait on the long term when it comes to issuance, and when he wants to issue more on the T-bills and the very short part of the curve. In Europe, it's quite difficult to see that government is controlling anything. I think they just have to issue. In Europe, 2027 will be election time for Europe. Maybe we will have a new government. The coalition in Germany is a bit at risk. We have France, of course. So I think, yes, central bank is controlling the short part of the curve, but the long part is not exactly some a place where anybody is in charge.
You bring up French politics. How much of the risk is currently priced? How much of the risk is going to get priced?
I think we can have some volatility, especially before the election, as all the major candidates will promise, a ton of money in terms of tax reduction or spending, and nobody will be very clear on how to finance that. So you could have some volatility. I suspect that as everybody has the eyes on that, it couldn't go too far. But frankly speaking, we are short France in our portfolio, not against Germany, but we still have a short on France because there will be volatility and there will be time to re-enter the market at a better price.
Okay, so what's a safer story in Europe? Germany, you've already kind of raised a couple of risks, but are there better trade? What's the better trade? Is it Italy? Is it Spain? If you're selling France, what are you buying?
We buy Italy, we buy Spain, we buy swap. But yes, we prefer, again, Italy, Spain, it's not that it is, low-risk country, but relative to France or relative to Germany, we think that you have the spread and you can still... not compression, but at least live on the carry without a lot of volatility. So yes, we prefer Spain, Italy to France and Germany.
We have a budget here in the UK coming up towards the end of October, Marianne. Do you expect the risk around gilts to come back, or have those concerns been assuaged? How vulnerable are gilts as we lead up to that budget?
I think the gilt is a bit vulnerable, but I wouldn't say that the budget is the main risk. The gilt is the high beta European or high beta world market. I think Burnham probably learned a lot from Liz Truss, so I I suspect he won't make the same mistake, and I will probably be more cautious on gilt because of inflation, because of global growth, because of the fact that UK has a weak currency. UK is has a twin deficit in terms of fiscal and current account. But I wouldn't say that the budget is the main risk on the UK.
There seems to be this disconnect within markets that inflation is actually coming in much higher, but break-evens haven't risen and there's not concern priced from a rates perspective. Does that correct? Is it explained in a reasonable way?
It's hard to explain, and because we can't, we are long inflation break-even everywhere because we don't understand why the market is not paying much more attention to that. The fact is, when you have a real yield in Europe, for example, you did an amazing performance because the current inflation print are well above what is priced in, so the carry of your investment is good. I think it's more the fact that nobody wants to bet against central banks for the moment, and you don't see any reason why inflation should de-anchor. The market is used to believe in central banks, so we don't understand exactly. So we take the opposite decision, and we are long break-even in US, in Europe.
Here comes the inflation. Marie-Anne Allier, thank you very much indeed. Fixed income fund manager joining us from Carmignac. President Trump, talking of central banks and not fighting the Fed, downplaying what has been bigged up as being a lot of contact with Kevin Warsh. This was what he had to say when questioned over Fed independence.
No, actually, the Wall Street Journal had a wrong story. He said I spoke to him. No, I have tremendous respect for Kevin Warsh. I've only spoken to him one time briefly, a few days ago, just a conversation. Look, he's going to do it. He's going to run it. I know what he'd like to do, but he has to run it. He's got a board. It's not only him. If it was up to him, it would be different. But he's got a board.
If it was up to him, it would be different. President Trump speaking there to reporters in the Oval Office, addressing the issue of Fed independence. We're going to have more on that central bank, where it's going next with interest rates. You got a couple of big events coming up. CPI is the next big one on the agenda. We'll talk about it next. This is Bloomberg. .45 minutes past the hour, 15 minutes to go until the opening trade here in Europe. You are looking at a tepid, slightly negative start to the day here in Europe. US futures, actually an hour or so ago, were looking a little bit more rosy. Looks like we're kind of beginning to roll over a little bit there as well. But yeah, an unexciting start. I think we're just waiting for the kind of the big story, CPI coming through. But I do wonder whether oil prices have yet to be fully factored into what we're watching here. Yeah, and some suggesting that maybe the spending commitments, these new spending commitments, apparently largely new from Nvidia, were doing something to lift Nasdaq futures. The details on that then: Nvidia partnering with some of Wall Street's biggest firms to unlock a $500 billion amount in terms of funding for AI infrastructure. The colossal deal comes amid a continued AI fundraising spree, of course, with Intel increasing the size of a new share sale to about $20 billion. We're joined now by Bloomberg's Anthony Stevens. Anthony, what do you make of these funding plans and what they tell us about AI sentiment? Is this a red flag for you, or is it a positive indicator?
It really depends on what your time horizon is, right? If you're a short-term trader, you don't like to see this kind of stuff because it's these big companies running with the cycle. They're investing at what looks like the height of the cycle in a very aggressive manner in very funky instruments. This is the first deal of its kind Nvidia has announced, and this is kind of reminiscent of the financial engineering that SoftBank was known for example. And what will Nvidia do with the money is another interesting concept. Now, Nvidia as a very high-grade grade credit, has started to see some weakness in the CDS market. So Nvidia CDS has weakened past some of these traditional hyperscalers. So that is something that the market will be quite new to. This is a cash cow, it's a cash machine stock, which is not used to any kind of tick watching in its credit. So that's an interesting dynamic. Now, Intel, it's important to note that the Intel deal is actually priced quite tight. This is a 70 vol stock, and this is trading at about 2 times the normal full day ADV of the stock. And for it to be priced at 95 is a very tight deal.
Now, sticking with AI spending, tell us about Anthropic's deal with Riot Platforms.
Yeah, this is another kind of deal that looks to lock down AI processing ability. Riot is a very interesting company. It was a biotech company first before pivoting to Bitcoin, and now that Bitcoin is kind of dead in the water, it's pivoting to use that computing capacity for AI, and it has actually beaten on results. So this is quite a new growth kind of dynamic for Riot. It's a new kind of vertical for them that is really doing well. And what's interesting about this contract is it might actually extend out to 2048, which is really far out there, and the kind of numbers can really start to add up for Riot in multiples of what has been announced. This just shows you how much money the Anthropic and OpenAI together are throwing at compute and trying to lock down compute that they don't own themselves. And this is a key risk for them as well. But for now, it's throwing off cash to many, many players in this ecosystem.
Yeah, it's amazing. Just to kind of watch where the cash ends up. We're now talking about cheaper models. We're now talking about open source models. Meta's getting on board with that idea. The Chinese are obviously pushing that idea very well. Token prices are coming down. If we commoditize this industry, does all this AI infrastructure spend work? And how does that change the narrative?
It really comes down to what has been starting to get kind of circulated, Jevons paradox, right? Do cheaper tokens enable a wider range of AI use cases? And there is some evidence for that in the latest earnings season. So a wide range of software companies have been talking about being able to use cheaper AI either in in-house versions of the open source platforms or just using the open source platforms themselves to develop software quite intensively for cheap, and they maintain these client relationships that they've built over the decades, and as a result get more profitability out of their clients. So the software ETF, for example, has bounced extremely hard against the semiconductor industry as the software companies start to reap the benefit of these much cheaper tokens. So, and that's also been seen in Asia, for example, with the Chinese software names ramping up quite strongly against the semiconductor space. So this space remains in huge flux, but it looks like software might be the new winner in the second half.
It's good, yeah, fascinating how this continues to oscillate. Anthony, great stuff. Thank you very much indeed. Anthony Stevens joining us on what is happening in tech. Let's turn our attention to kind of the wider market, I'll learn to talk, implications of this. Mark Cudmore is here, MLIV editor, to give us his take. I read your notes this morning, Mark. AI CapEx burning through investor cash, but there's a lot of cash. So how much further does this go?
Look, my answer is going to be a little bit boring here, Guy. It's going to be the same as I said for probably the last sort of year, maybe it's 9 months, I don't know. Next earnings season's always what I'm looking at, and it's going to constantly be the next rolling earnings season. It's not because I think it blows up specifically in the next earnings season. It's because I think the AI CapEx bubble bursts when one of the hyperscalers changes tack on their capital expenditure plans. And I think that can happen outside kind of results season, but I think it's unlikely to. So I think it's most likely we get to earnings, or at least we get a hint in those earnings seasons that, hey, it's not really working, or the revenue's not coming through fast enough to kind of keep up the kind of hope, the pipe dream that we might see the revenue explosion that will justify the CapEx explosion that we're already pricing in. So I kind of always think it's the next earnings season. Do I think my base case is the next earnings season? Not necessarily, but I think you've got to be alert to it. We're already quite far through inflating this AI bubble. It can have plenty more to go. This most recent earnings season shows that it's still going strong for now.
And you've talked about as well, Mark, in your notes about the fact that this additional spending could be marginally negative for Treasuries. Watching Treasuries, of course, in the lead up to CPI inflation out of the US tomorrow. Is that inflation print backdated to July? Is it less important now, given what we're seeing in terms of higher gas and diesel and oil prices?
Maybe, but I think we keep on dismissing each kind of marginal data print that comes through because we're saying that the situation is so dynamic. I think, though, what is interesting here is the context of Treasuries. I think the pressure on Treasuries is going to be a real theme going into year-end, into midterms. We have fiscal incontinence in the US, which is unlikely to change before the elections. We don't have great policy credibility from various parts of the US arm, whether it's the Fed or the Treasury at the moment. And I think we've got, clearly an inflationary backdrop. We can negotiate or debate about exactly to what extent. But I think the backdrop for Treasuries is very negative, and I think that pressure is going to increase into year-end. The expansion in hyperscaler debt doesn't help that, and it's with that context that we've got US CPI print this week.
I mean, it's an interesting one. We've had a mixed reaction yesterday in assets in terms of oil prices up, but gold is also up, and there's all this optimism around Europe still. Does that need to be put into the context of the risk of higher oil prices and the fact that we started the year with the 1.2% real GDP forecast for 2026?
I think that people are starting to cope with the higher volatility in oil prices and with higher elevated oil prices. Of course, if we see Brent crude spike well above $100 again, that will derail some of the kind of the bullishness around Europe at the moment. But I think that if we're with volatile at this range of $80 to $100, I think European stocks will cope and the European bullish story will sustain.
Mark, great stuff. Thank you very much indeed. Bloomberg Market Live Executive Editor Mark Cudmore. Thank you very much indeed. Skylar's got to go back to work for Mark now, to be honest, and stop helping us out. But she'll be back tomorrow. We continue for the next hour.
I think it's worth noting oil prices have just popped up a little higher, so up to 2% now, 1.8%. So you're closing in, it's $89 a barrel on Brent right now. Energy was the best performing sector across Europe yesterday. The same may be true again today on the back of the price action.
And what does that mean for the bond market? What does that mean for US equities are beginning to roll over a little bit? We'll see how that trade works its way out. Anyway, 5 minutes to go. The opening trade is next. This is Bloomberg. Tuesday morning, good morning. Couple of minutes to go until we start cash equity trading here in Europe. At the moment, the picture looks fairly muted at an index level. This was the picture out of the States yesterday. Europe goes out here. We kind of pushed down towards the end of the session, so that's a factor you've got to put into this story. You've also got what is happening with Nvidia, what's happening with Intel to fold in too. But as Tom was pointing out just a couple of minutes ago as well, you're also seeing oil prices just beginning to jack a little bit higher now. We're watching what is happening in the Gulf very carefully. Plus, there's actually other stories as well to fold in to that energy complex story too. So Euro Stoxx 50 futures are down by, let's call it 0.1%. FTSE's actually still down as well. So do I take the energy trade out of that? What else is moving that index? DAX futures are absolutely flat. So at an index level, I don't really have very much to add. But at a single stock level, there are things happening, not as many as are going to be happening later on in the week, but there's still some stories to watch, Tom.
Yeah, we had one earnings coming through from IHG, Intercontinental Hotel Group, coming through with a modest beat. So it was a beat there. So we're watching IHG on the back of that news. UK retail is in focus, some evidence suggesting that there's a slowdown in terms of sales, so we'll see if there's an impact there. And on defence, we've had some initiation in terms of coverage from RBC and Barclays and some upgrades for some of the big names in the defence space, including the likes of Leonardo, Rheinmetall, Thales, BAE. So we're watching the defence space as well on the back of that coverage and some upgrades from RBC and Barclays, Guy.
Okay, here we go. So let's talk about what we're going to see at the open this morning. I suspect it's going to be a bottom-up kind of a market. You're going to watch some single stocks. You're going to watch some sectors as well. What happens with energy? What happens with some of the commodity trades this morning as we continue to see the Gulf close, I think is going to be one of the narratives. At an index level, I don't think you're going to get very much, though, net. It'll be interesting to see what the volume picture looks like as well today. So let's get these markets open. Let's show you what's happening with the opening trade. The initial reaction is very mildly negative. We don't have kind of a catalyst right now to move the index story. But I'm surprised that we're not seeing maybe a bigger reaction as a result of the tick higher in oil. Stock 600 doing absolutely nothing. FTSE 100 up by 0.1%. we were expecting something slightly negative, but I think we're well within the kind of plus or minus here. The CAC's absolutely flat. The DAX, if the DAX is open at this point, you know there's nothing happening in the German market this morning. DAX is up by 0.2%, AEX is up by 0.2%, IBEX is up by 0.1%. At an index level, nothing. Actually, if the DAX is open already, I just wonder whether actually at a sector level there's not much happening either, Tom.
Well, we're seeing similar echoes of what we saw in terms of the sector breakdown yesterday. So energy is at the top of the list, of course, unsurprising given the move higher in terms of Brent WTI. So energy is currently up 1% after the gains. It was the best performing sector yesterday, as we mentioned. On the downside, travel and leisure, that was also ended the session yesterday in negative territory. So travel and leisure, again, under pressure, obviously, obvious reasons for that in terms of high energy costs and the geopolitics, of course, around Iran. So that sector is down 0.7%. Tech performed modestly well yesterday in the European session. As a sector right now, it's just up 0.1%. Basic resources, we're watching, of course, things like the copper price, which broke above 14,000. You've got gold in focus with 4,400, but it's now actually down 0.5 gold, taking a modest knock and at 4,366. Basic resources, though, as a sector, is up 0.2%. And then on the downside, the biggest losses, as I mentioned, travel and leisure, also real estate, just down 0.2%, Guy.
Yeah, ASML is the biggest points add. Shell and Total, BP are in the mix, so that's the upside move in energy. Some of the industrials are softer again today, so Safran, ABB, softer a little bit. Rolls, maybe Airbus, seeing some softness there as well. So the industrial trade is once again giving back a little bit of ground. Defence is kind of a little bit higher, and banks look like they're going to be a little all over the place. I'm going to watch UBS a little bit later on as well to keep an eye on what happens in terms of this government capital requirements, and we may get some clarity there. So maybe watch the banking sector for a little bit more clarity on that front. Yeah,
we mentioned the defence as you touched on as well. So you've got the likes of Kongsberg, you've got likes of Saab, currently up 3.7%. Kongsberg gaining 2.5%. Some upgrades there from RBC and Barclays. Let's get a broader perspective on these markets and bring in Benedict Lowe, European equity derivatives strategist over at BNP Paribas Markets 360. Benedict, good morning. You are positioning for a grind higher in European stocks. Just explain that rationale in the face of higher energy costs and concerns about inflation once again.
Yeah, so it's undeniable that the macro story is picking up in Europe. We've got growth that is surprising to the upside, activity on the rise, and earnings that have been good. Actually, earnings have been exceptionally strong in the US, but also very good in Europe. It's been one of the best earnings seasons over the past few years. And all of this is happening in a context where positioning is low to neutral. So that points to a positive picture for stocks. Now, the counterpoint to that is that a lot of positive news is already in the price, and with seasonality that is not supportive for higher stock price up until the end of September, October, we like to position for what we call a grind higher in stocks, and we like to minimize the premiums that investors are spending on upside positioning.
How do you mitigate the risks around inflation, whether it's soft commodities, whether it's diesel, whether it's gas, oil prices? If this is the status quo right now around Iran and that is prolonged, how do you hedge around that?
So one of our top pick at the moment is the banking sectors. We think the banking sectors is one of the best sector position for end of year. First of all, PMIs are on the rise, as I mentioned, activity is picking up, earnings that have been good, but also higher inflation mean higher rates. We're expecting the ECB to rise rates come September meeting, and that is positive for the banking sector, a cyclical sector that has, yes, really performed well over the past few years, but we think there's still some upside for that sector.
How do you minimize premiums for investors?
So you want to look basically at not paying the full right tail of the distribution, so looking some types of like call spread or call spread versus put, depending on the sectors that you're looking at or the index that you want to look at, is how we look to mitigate premium spend.
How much volatility are you expecting?
I'm sorry?
Volatility.
So what I think is the most striking parameters in the vol space at the moment is skew. Last week, we've had massive repricing of upside vol in indices such as NASDAQ, but that led repercussion in S&P and on 5E. And this is where most of the dislocation holds at the moment, where skew is actually quite low and offers some opportunity.
How much? The markets were all over the place last week, but it didn't feel like a fundamental story. It just felt like a repositioning options story. Is that what's driving this market at the moment? It's all about kind of how dealers are positioned, what's happening in terms of where the gamma line is. It feels like that is where the narrative is, rather than trying to make some sort of fundamental analysis as to what is happening in terms of is the AI trade on or off or whatever.
Yeah, I would say two things. On the directional basis, it's been a dispersion story. 2026, we've had the outperformers, the bank, the tech stock on one side, and we've had the laggards, consumer discretionary, and then also the autos that have kind of mitigated the move at the index level. But on top of that, you need to put what the dealer's positioning has been. And we've seen a lot of leverage on single stock space in the US, and we've seen also this short dealer gamma positioning on the upside last week that led to a bid in upside vol.
Are investors, are we seeing distortions as a result of the leverage story in the US on tech, the leverage story that we've seen, and there's been some clear out in Korea as a result of a regulatory crackdown? But what is that leverage play doing more broadly to the flow show?
Yeah, so we've seen basically, first of all, the leverage has come down massively on some of those names. What we found out looking at past periods of stresses on semi stocks is that we tend to have the initial bounce back that we saw last week, but then it tends to be followed by around a month where stock kind of trades sideways. Basically, investors look back at their risk management and all of that, and then the stocks tend to rally. So we are also looking for this kind of consolidation period until we see a bounce back in those stocks.
Would hikes from the Fed derail your constructive view on equities? And if so, how many? Would it be 1, 2, or would a Fed that's staying on hold in an environment of higher prices and higher inflation and question marks about Fed credibility be a challenge? So
at the moment, we're expecting a mini rate cycle from the Fed starting in December, then January, then March. Now, the market is pricing around half a hike for September meeting. What we're seeing is this print this week is quite important for the Fed pricing of a rate hike come September. If we do get a print that is more hot than expected, around 0.3 or higher than that, it's likely to get priced in more. And where there's more risk on the equity side is for indices like the Russell. It tends to be low quality, more leverage, and those type of indices that to underperform in a period with where the Fed is raising rates. So those are the index where we're looking at hedging at the moment.
There's a lot of noise out there at the moment. Volatility, though, is quite low. But I'm wondering whether or not, if we got resolution to some of that noise, how the options market would respond to that. Would clarity be a good thing or a bad thing? If we resolved what's happening in the Gulf tomorrow, how would the options market respond to that? Would it respond positively or negatively to that once you start to see some certainty? Optionality is when you've got lots of different things going on, you want optionality. If you start to have clarity, do you need optionality?
Yeah. So I would say, and what we've learned last week is that if we do get the positive news and stocks break higher of the range that they've been, this is going to happen in a spot of volatile type of dynamics. People are going to chase the upside positioning, and this is going to lead to a bid involved on those upside positioning. So we are thinking if stocks move higher, this will happen in a more volatile, with implied vol getting bid.
So, ironically, clarity...
higher option prices.
Yeah, higher options prices, which, I don't know, seems counterintuitive to me. Does what is happening now feel logical in terms of the way that we're seeing markets responding? How much of this is liquidity? There's a lot of liquidity out there at the moment, but how much of this is... Does the market feel fundamentally driven, or does it feel that it's being driven by internal financial factors which are unrelated to what's happening in the real world? How much of this is a kind of closed loop scenario happening within the option space?
So I would say there's been this magnificent story around the tech sectors, and I think options have been trying to catch up and see where to position. We've had massive level of volatility on those stocks, so people are trying to see how they can hedge on the downside without paying too much premium, and how can also position on the upside. But the premiums have been so high that some people stayed on the side, but when things happen, they need to catch up and position, and hence this massive bid involved. So I would say the very elevated levels of vol on those single stocks, or even on the sectors as a whole on the Nasdaq, has been a struggle from an investor positioning in how much premium you're ready to pay on those sectors or on those singles now.
Is there a level of yield on the 10-year that would fundamentally restructure some of that positioning if we think about risk-free, or at least the risk return analysis for investors? If we're getting to 5% and you can lock in 5% as an investor,
Yeah, the 5% has been discussed a lot around the 30-year maturity in the US. Now, the reality is the economy is good. Earnings have been really good. So if you get a better yield on your equity side, you can get higher bond yield and the picture can still be attractive for you to invest into equity markets. I think what has been quite surprising is that expectations were high in the earnings season, but companies still managed to beat on the upside. So as long as your earnings part is still increasing by a bigger factor than your yield part, then it's still interesting to invest in equity market. That's still where you're getting the best yield for your money.
Yeah.
Do earnings seem sustainable? Analysts are pricing in an awful lot of forward earnings. Does that seem real to you?
I mean, it's been the case for a few earnings, and companies have continued to beat on the upside. So we're saying that there's this whole part of the economy that is getting unlocked. Now, there's a lot of expectation. We saw some worries around hyperscaler, CapEx spending. So I think there's going to be those pockets of worries that are going to come back. Are they able to monetize on some of their huge CapEx numbers that they're seeing? Is the bond market able to digest those huge emissions? But at the moment, as long as the earnings part is picking up, then that's the best place to invest.
Okay. Nice to see you. Thanks for coming to see us. Benedict Lowe, European Equity Derivatives Strategist at BNP Paribas Markets 360. Core 6 looks like this. SML, in fact, tech generally having a sort of better time of things. Energy prices are also looking fairly good this morning. So you're seeing some pickup there. It's interesting to see that farmers actually, you're seeing some money rotating into that space. It was very unloved for a long time. That has now changed, as you can see on the left-hand side of the screen. Okay, Chloe's here with some details on some of the other stocks which are not on these boards. What do you got?
Good morning, Guy. We have got PNE, which is a company that manages onshore and offshore wind farms. And we're down quite significantly this morning because it received takeover interest that was below its market share value. And so we're down about 11% on the back of this morning. We are also in the red for IHG Intercontinental Hotels Group, the hotel operator that has actually beat estimates this morning. But there's strength that there was in the US market in particular with, strengthening economy, and the FIFA World Cup was maybe enough to offset this impact from the Middle East, but maybe the beat was just not quite enough to reassure investors that travel demand was really coming back. So we're down about 2% on the back of that this morning. Moving on to the defense sector, because RBC analysts have initiated a few of those companies this morning. Saab, Kongsberg and Rheinmetall all initiated at a buy rating, with the analysts saying that there was going to be really strong growth from European rearmament, and that was going to continue as well beyond 2030, although at a slightly more modest level. So we're in the green across the screen there, except for BAE, seeing a little bit of weakness there. Moving on to Lion Finance, which is a small banking group that serves customers in Georgia and Armenia. And there we've got a buyback extension, moving the shares forward. We're up about 4% on the back of this. And finally, Alcon, a Swiss manufacturer of eye care products, is up this morning about 5%, so quite strongly after raising its guidance and beating estimates. So quite strong earnings there reflected in that share price.
Chloe, thank you very much indeed. Some of those stocks on the move this Tuesday. Chloe Melee there. Coming up, Germany's car-making icons are being humbled in China as sales of homegrown EVs race ahead. We have more evidence of that. That story and insights are coming up after the break. This is Bloomberg. Welcome back to the opening trade. We are 17, almost 18 minutes into today's session. Top of the list when it comes to sectors. Energy up 1.2%. Brent is closing in on $90 a barrel. Across the benchmark, Stock 600, you're seeing a modest grind higher, up 0.1%. On the downside when it comes to your sectors is travel and leisure, currently down 0.9%. And again, you can tie that to what's happening in terms of the oil price.
Yeah, maybe that is the factor. And that maybe explains why we're seeing IHG under a little bit of pressure. So the numbers looked broadly out of the hotel operator pretty good this morning. It looked like they'd beaten on a lot of the metrics. The forward numbers look pretty good as well. Why is the stock down? There could certainly be a kind of oil price factor here, but the entire sector is looking like it's under pressure, we just indicated. Let's talk about this, get some sort of sense of analysis on what is happening here. Conrad Gaynor, European travel and leisure analyst at Bloomberg Intelligence, joining us. for a kind of take on what is happening here. I'm a little surprised to see IHG down as much as it is this morning. Do the numbers justify a drop, or is this just a stock that's had a decent run recently, maybe showing a little bit of fatigue, and the entire sector is under a little bit of pressure as well?
Yeah, and thanks for having me. It was a decent set of results, right? They beat on RevPAR growth, which is the main metric, 3.5% 2Q RevPAR growth. And I suppose the big story there was the Americas beat. Now we all know about the World Cup. They've attributed 1% of the 5.4% America's RevPAR growth to the World Cup. I suppose we knew about that already from what the peers has reported. There would be this uplift. There's a smaller benefit to come through in 3Q. Perhaps we might get a little bit more cautious towards 4Q when we get to the midterm elections. But then, if we look at, say, the Europe, Middle East, Africa and Asia Pacific region, that was maybe a little bit better than expected. It posted some growth. I mean, that includes the Middle East, which was hugely disrupted by the Iran war. If we strip out the Middle East of that, from that, we get about 4% RevPAR growth. The UK, East Asia and Pacific performing particularly well. Group business strong for that part as well. Greater China maybe a little bit weaker than what we would have thought. That was 0.8% growth at 2Q. That was impacted by holiday timings. And you had this sort of polarization of tier one cities, Taiwan, Hong Kong, within Greater China doing well, and tier 4 cities doing well because they have resorts, but the tier 2 to 3 cities weaker.
Conroy, that's so interesting regional breakdown there for IHG. What are you watching for, you and the team, in the quarters ahead in terms of the key growth drivers for IHG, whether it's regional or whether it's in the kind of the pipeline that they have right now?
Yeah, I think the big overarching theme across the travel and leisure space really is this premiumization trend. I mean, we expect the lifestyle hotels, the luxury, the sort of premium end of premium hotels to outperform, and we've seen that across airlines too, really, with premium cabins doing well. So we think that this, we maybe are in a little bit of a two-tier economy where the people that the more affluent can travel and afford these things. Maybe we're seeing some more softness in demand across the value end of travel. And really, as we look at the geopolitical things that are happening every day, higher oil prices, higher bills in general, may just start to pinch the wallets of the lower income population as well.
It's interesting to watch. Yeah, it's quite an interesting macro take on what is going on here. Conroy, thank you very much indeed. Conroy Gaynor joining us from Bloomberg Intelligence on the IHG story, the CEO of which is going to be joining us a little bit later on. Ellie's going to be on with the surveillance team. I think that's around 11:30 UK time.
OK, from travel and leisure to the auto sector right now, because after decades, of course, of winning over Chinese buyers, Germany's automaker giants are being humbled by a slump in sales. The struggle in China comes as the German car makers face mounting pressure from domestic manufacturers. Let's get more with Bloomberg Autos and Transport reporter Danny Lee. Danny, just remind us, what is the latest data, what are the latest sales numbers telling us about the woes of German automakers in China?
When you look at Volkswagen, BMW and Mercedes, they are all really struggling. And when you zero in on the premium segment, so for Volkswagen, it's its premium brand. Audi, there's a couple of figures that really represent this decline for them, and that they are really in a lot of trouble. From 2020 to now at the end of 2025, all three of them, the trio of those brands, have seen their market share gradually erode to a point roughly they've lost about half of their market share. And now by the end of 2025, they fell to single-digit market shares. It just goes to show how much of their share has been eroded, particularly by the Chinese EV competition. And also the fact that earlier this year, we've seen their warnings on Mercedes, BMW, and from Volkswagen. In terms of the outlook, the warning that their guidance for 2026 cannot hold because of, in large part, what is going on in China, where they are overseeing quite significant erosion in their share of sales. So it's a really tough picture when you look at how the German vanguard of auto industry is really struggling out there.
Okay, Danny, is there any sign in any of the vehicle lineups, in their cadence in terms of producing new technology, that this is going to turn around anytime soon? Or is China gone for the German automakers?
Well, it is amazing just when you look back at how, for the Germans, China being a huge growth market, the prospects that they had and their standing, and that's really been ebbed away at. The fact now that the Chinese automakers have really raced ahead in terms of performance and technology, and the fact that the Germans and other foreign automakers have to catch up ultimately to match them in terms of that level of range, for example, for EVs, or the kind of tech that they really install in their cars. It really goes to show what happened to Mercedes, the fact that it partnered up last year with McDonald's, of all kind of brands in China, replacing the silver arrows with a cheeseburger figurine to try and drum up sales with China's youth, younger drivers rather. In the first half of this year, they only sold 1,157 units of its all-electric sedan CLA, and that really compares to Xiaomi, for example. Upstart, Chinese brand, sold 80,000 over the period. So they are really being driven in almost into a sense into irrelevancy with the kind of positioning and kind of technology that they've been offering for quite some time.
It's such a remarkable turnaround. I remember when I was based in China, Danny, it would be the complaint from German execs would be we're not getting enough units into the country to meet the demand. And I remember speaking to CEOs, they're saying we have clients who are paying in cash for Porsches, suitcases of cash. I mean, these things, this has turned around pretty dramatically. On the Chinese side, are Chinese automakers actually making any money at this point, Danny?
Well, for the Chinese automakers, they've clearly had to dig deep into their finances to fund their kind of innovation, evolution and growth strategy. And now you do see the tables being turned around when you see the likes of Mercedes having to consider the reality that they are going to have to sell for example, their CLA all-electric sedan at a loss in order to lower the prices and to try and keep up with the Chinese EV makers. The fact that the Chinese EV makers have the tech, they have the cost base, and they have the sales and momentum, it all really leaves them in a decent position. The fact that what we have obviously seen, Tom, abroad is that the Chinese are conquering markets like Europe in a way, particularly with high oil prices, high petrol prices, that you do see the tables very much being turned. And for the European legacy automakers, it is a really tough position for them to be in.
Danny, great stuff. Thank you very much indeed. Danny Lee on what is happening with the auto sector. He mentions gasoline prices. Brent crude is up circa 2% right now. TI is up by circa 2%. Aluminium's up by 1.63%. Next, we're going to talk about commodity prices. Eva Manthi's going to be joining us, commodity strategist at ING. Maybe throw a bit of gold in there as well. That conversation coming up as we watch these metals prices with a great deal of interest at the moment. Commodities prices broadly are higher. We'll talk about them next. This is Bloomberg.
This is the opening trade. We are 30 minutes into today's session. That is the picture across the benchmark stock 600, currently flat. In terms of the sector breakdown, we'll get into some more details shortly, but you've got energy at the top, you've got travel and leisure at the bottom. The last time I checked, the DAX is currently up just 4 basis points, or 4 points, I should say. The CAC current is currently a little lower, and you're flat on the FTSE, or at least down 0.1% on the FTSE 100, which is interesting given the higher energy costs that we're seeing. You do have Brent closing in on $90 a barrel. Volumes are telling a story, Guy.
They certainly are. I see your exciting board and I raise you this exciting board. 247 up, 327 down. Nothing to see there. Look at the volume. Actually, it's got a little bit better as the session has picked up a little bit, but we're still there's not a lot going on out there in terms of volume transactions. So we're in the middle of August. I think we can probably conclude from what we are seeing here. Single stocks move, there's some excitement there. Alcon out with numbers this morning. iCare we're talking here, and the numbers look okay. And as a result of which, that stock has done a little bit better, as you can see. Saab doing well. I think got a bunch of upgrades on the defence space this morning, which is certainly moving that sector around a little bit. Have we reached the near-term bottom? Will we bouncing? And then ISS. What does ISS do? It's not space stations. It's buckets and mops. This is the company which you probably see around your office but don't notice on a fairly regular basis. It provides a lot of janitorial services and goods to up by 2.42%. So there's demand for that side of things at the moment. IHG is not doing quite so well this morning. It's had a good run. The stock's rolled over a little bit over the last few weeks, and that continues this morning down by 2.6. Ellie Malouf's going to be on the surveillance show a little bit later on. M&G, I think, is a downgrade story. Spirax is an industrial company down by 8.56. In fact, industrials broadly, I think, are showing some signs of weakness today, Tom.
OK, here's what else you need to know this morning. Another wave of intense heat is set to sweep across an already parched Europe, of course, this week, raising wildfire risks, threatening crops and drying watersheds feeding the region's critically low rivers. Temperatures in northern France are expected to hit 40 degrees Celsius, while southern England may reach the mid-30s. Nvidia has struck a deal with a series of private market giants to invest $500 billion in AI infrastructure. Meantime, Intel is set to raise $20 billion in its first share sale since it listed in 1971, increasing the amount it was planning to sell after getting more than $100 billion in orders. Oil holding on to gains this morning after President Trump made sweeping new demands of Iran. The president is calling for Tehran to pay compensation for damage and deaths caused in conflicts across the Middle East. The demands come in response to Tehran's requests for reparations over the US-Israeli war on Iran. Guy.
OK, let's carry on that conversation and talk about what we're seeing. WTI crude up by 2% this morning. Brent crude is up by 2% this morning. Nat gas, which saw a huge lift yesterday, continues to climb as well. We're up by 0.8%, but we saw a 10% move yesterday in Europe as we see concerns growing around what supplies this winter are likely to look like. Let's get an update on all of this and figure out where we go next. Our energy reporter, Anthony DePaola, joining us now for an update. We're seeing some big demands, Anthony, being made by both sides now, Iran and the United States. The market's conclusion appears to be we're not opening the Strait anytime soon. Is that the correct interpretation?
Good morning, Guy. Yeah, it seems like the view is that we're going to have this kind of protracted reduction in traffic out of Hormuz because it's not fully open. We are still seeing a trickle of vessels going through. We are still seeing some of those oil tankers getting through as some of the countries, particularly the UAE. We've seen some Iraqi tankers going out as well. They're pushing vessels through the strait using that Omani route, but it's really contested. And as we've seen strikes, even as recently as over the weekend, an Abu Dhabi vessel was struck on Saturday, according to the state media agency. Those are enough to keep people from wanting to go through Hormuz. It's difficult to get shipping. Prices have increased. There's a lot of risk in there from sending a vessel in with the possibility that it gets stuck inside the Gulf. So that's a real block to getting energy supplies out of the Gulf. And that is continuing despite the talk that we're discussing a deal, that we're close to a deal. That's not enough for the market. The market wants to see free flow and safe transit of Hormuz before it considers that open. And of course, as you alluded to, the comments from Trump overnight asking for compensation from Iran, these are just really stepping up the demands from either side. And so that's not going to be conducive to reaching a deal. We had also those comments from the president over the weekend saying that they were kind of taking it slowly, low-keying it, I think was his phrase. So does that mean that this is simply going to stretch on for a period and we're not going to get a resolution? The U.S. is banking on Iran going bankrupt first, whereas Iran will be looking at the U.S. resistance to high gasoline prices, and particularly Trump's resistance to high gasoline prices as we go into the midterms there. So it's a waiting game, and that doesn't spell a pretty picture for the oil markets, Guy.
Certainly does not, and that's being priced in this morning. Anthony, thank you very much indeed. Anthony DePaola joining us out of Dubai on what we're seeing in the Gulf right now. What is interesting is it's not just restricted to the energy complex. You're also seeing elsewhere action in the metals market as well. I'm watching aluminium this morning up. That obviously is a metal that does have some concentration in terms of production in the Gulf. Eva Manthi is commodity strategist at ING and joins us now. Eva, good morning. If we continue to see the Gulf remaining closed, if the Strait remains closed, talk me through how that affects the metals markets. I've got aluminium up. Is that related? What else should I be watching?
Yeah, of course. So if you look at the commodity space, apart from oil and gas, aluminium is probably the most affected commodity by the Gulf disruptions. So the market is really focusing now on the physical tightness for aluminium. That's why you see prices rallying once again. We saw some of the geopolitical risk premium come out of the aluminium market as we saw tensions in the Middle East easing in early June. But the important point is that the lost production hasn't simply come back to the market. And you have to remember that restarting aluminium smelters is a long and technically difficult process. So supply remains constrained, and with the market still tight, prices are finding support again.
OK, we've also got energy prices rising too. If you assume that you need an awful lot of electricity to produce aluminium, energy prices are going to be a factor. Gas prices are climbing rapidly. How much of a factor is that?
Yeah, of course, aluminium is such an energy-intensive metal, so that's also having an effect on aluminium prices. And as you see more of that energy constraint, then you'll see also aluminium output constraint, and that's going to have an effect on aluminium prices as well.
Good morning, Eva. Is there additional production we can expect out of China when it comes to aluminium?
Yeah, so China has certainly helped during this Middle Eastern conflict. We saw production already running at very high levels. But also for China, capacity is relatively close to its ceiling. So China can mitigate some of the tightness outside of China, but there's really limited scope for a huge additional supply response from there.
On copper, we're looking at 14,000, closing on 14,200 on copper. It seems like the analysis I've read is that most of this is down to expectations around tariffs from the US. If those don't come through, do we get how rapidly do we unwind? There's a lot of tightness now in this copper market, it seems.
Yeah, so the US tariffs are probably the biggest risk for copper in the near term. If you see refined copper included in the tariffs, then you probably see shipments into the US accelerating further ahead of the possible implementation. But also you have China trying to attract metal at the same time, which would tighten the rest of the market even further. So if refined copper remains exempt from those tariffs, we probably see the US pull on the metal weakening, and some of that metal could become available elsewhere. So I would expect some of the current tightness and probably some of the price to unwind as well.
How much AI is there in the copper price?
So AI is definitely supportive for copper demand. Because for copper, it isn't just about building more data centers. It's also about the power infrastructure that has to sit around them. So we will need to see significant investment in grids and transmission and generation as we see that electricity demand growing. And copper is particularly exposed to that because of its use in cables and transformers and electrical equipment as well. But aluminium also benefits from that.
Yeah, there's a substitution effect also into aluminium as well, I guess. If you were to see the AI trade rolling over, say a hyperscaler said we're not going to be spending as much money, and you start to see the whole kind of complex coming down, what's the beta in copper to that aluminium, to that AI trade? I.e., if the AI trade falls apart, does copper come down hard with it? Or, as you say, because of the infrastructure build-out that we are seeing, which is probably longer term, that it's reasonably insulated from the volatility that could come?
I think that probably on its own, really AI data center demand is not really big enough just yet to move the copper market. And like at the same time, I wouldn't say that AI is suddenly going to create a copper shortage, right? But it adds another source of demand to a market where the supply response is already constrained. So even a small incremental demand adds to the support to the price.
But when you look across these commodities, do you think markets are underestimating the inflation input coming through from these higher prices on commodities?
Yeah, perhaps, but as I was saying as well, that you actually have fundamental support for both of these metals that we were discussing. So both for copper, actually supply is tight. And for aluminium, supply is tight. Like we are expecting around 1 million ton deficit of aluminium for this year. So fundamentally, these metals are supported.
Okay. Eva, can we just wrap up on gold? Down today, but we've seen a big rally. What was behind that rally? Does it keep going? I appreciate it's down today. Do you think there's further upside here? Or are you surprised to see the big pickup that we've seen over the last few days?
I think for gold, we're finally seeing several sources of demand coming back at the same time. So we have central banks picking up their buying again. So, for example, China has increased their holdings last month again. But I think more importantly, ETF investors are also returning to the market after several months of weaker demand we've seen. And at the same time, you have expectations for US rates becoming more supportive. And I think that has taken some pressure off gold. So I think that overall, this rally perhaps has a somewhat stronger footing because it's just no longer relying on just one source of demand.
OK, a stronger footing for the rally in gold. Currently down 0.7% at 4,357, but that rally has been there in recent days. Eva Mante, commodity strategist at ING, thank you for those insights. Coming up, we're going to switch focus to the banking space, specifically UBS, waiting with bated breath as Swiss lawmakers vote on diluting the government's capital reform plans. We'll see if they do indeed do that. We will have the latest next. This is Bloomberg.
Tuesday the 11th, welcome back. 47 minutes past the hour. I'm filling here, basically. I'm trying to say exciting things about the time and the day because, to be honest, there's not much actually happening out there when it comes to the equity market story. European equities are flat. There you go. You can see it on the screen. Not much happening at the index level. There's a few single stocks that are certainly moving around today, but at an index level, we are 1/2 either side of the negative line. The AVAT line also tells quite a significant story this morning on your Bloomberg terminal. Check it out. Get one of the drop downs, and you'll see that volume is very light. We are in the dog days of August, Tom Mackenzie.
OK, let's find something of interest
through
the rest of the day. Let's look ahead to what else we're watching. This one is good. We'll get some more details on this in the next minute or so. But the Swiss Parliamentary Committee, a really important parliamentary committee, is going to be pushing through potentially with a recommendation on proposed tougher capital rules for UBS. Maybe they'll adjust that. Again, we'll get some updates out of Zurich momentarily. At 11 a.m. UK time, US NFIB small business optimism data comes through, so we'll be across that for you. At 1:30 p.m. UK time, Hungary's parliament votes to select its new president. of course, an adjusted relationship with the EU on the back of changes at the top in terms of the politics of Hungary. US primary elections taking place in Connecticut, Minnesota, Vermont and Wisconsin. And on the earnings front, as we think about AI infrastructure, once again, we've got earnings coming through from CoreWeave and Supermicro Computer. That's after market. Let's get more on that big decision for UBS right now, because the Swiss Finance Ministry has proposed making the lender hold the full book value of its foreign units in equity capital at home. It's a measure that the bank has lobbied strongly against since it was first floated back in 2024. We're joined now by our Swiss finance reporter Miriam Balazzo in Zurich. Miriam, just remind us what led up to this debate and the vote today that could potentially prove pretty crucial for UBS.
Yes, absolutely. Well, I'll take you back 3.5 years ago when Credit Suisse collapsed. It completely shook the whole country, and UBS came to the rescue and became this giant financial titan, which is much bigger than Switzerland itself. And obviously this was wonderful. However, if UBS now were to collapse, it's presenting a huge risk for the country, because Switzerland state and taxpayers essentially would struggle to bail the bank out without completely bankrupting the country. So the government came up with this capital rules that would require UBS to back its foreign subsidiary by 100% and purely in equity. At the moment, bear in mind that they only have to do 60% of backing. So it's a huge change. And UBS has been lobbying for almost over a year now to just get this 100% backing requirement reduced. So Parliament are debating as we speak. There'll be another hour or so, or maybe a couple more hours, to debate whether they can dilute that figure. It's not clear whether they go 60%, 80%, we don't know yet. But that's definitely just the government trying to get UBS to build its own safety net, basically.
Has there been a shift in tone? Because if I'm a UBS shareholder and I want to get back to the days when UBS was one of the biggest payout banks that existed in Europe, this is crucial. So what are we expecting from these lawmakers? Any hint that maybe they are going to dilute it?
That's the expectation, but you never know. But there's been people in UBS's corner in Parliament, so the bank is hoping that things will shift, but something that will change for the bank drastically is just getting a bit of clarity, because it's been quarters over quarters of the share price dragging because of this uncertainty, and it prevents UBS from doing bigger potential acquisitions. It also holds the whole global strategy of the bank. So we need clarities. Shareholders have been patient enough, and I think they're waiting also for that bit of clarity. There's an expectation that it'll be diluted. I think the question mark is how low would the Parliament go? That's still up for debate, but the clarity will already change the share price trajectory.
Miriam, great stuff. Thank you very much indeed for the update. We'll watch for the news a little bit later on with keen interest. Miriam Balazzo joining us out of Zurich, Tom.
Let's bring in Adam Linton now from our Markets Live team for another take on these markets. So, Adam, we're seeing yields up. You're seeing a sell-off again in gilts. Brent closing in on $90 a barrel. Essentially flat across the European benchmark. You think European stocks though can grind higher despite the energy price increase that we're seeing, despite higher yields, despite the pressure on bonds?
Yeah, I think we potentially have a bit more further room to run here. We're most of the way through Q2 earnings season, and the results have been pretty stellar. I mean, net profits, they've been up about 17.5% compared to around about 11% consensus, which is the best quarter since 2022. But also the breadth of the rally is relatively healthy. The amount of companies above the 200 DMA, that's most since 2024. And we're also seeing earnings expectations just continue to ratchet higher. And a lot of that is basically confidence that the onset of the Iran war hasn't been as severe as people expect. Yes, that could potentially change, but the macro data is definitely holding up. European surprise indices, they're exceeding the US now That's for the first time since the onset of the war. And we've kind of seen a bit of this asymmetry at the moment on an intraday basis, whereby bad news isn't really hurting European equities too much. But when we do get good news, not that there has been that much recently, it does add further juice to the rally. And also as well, it is a bit of an offset to some of the wavering that we've seen enthusiasm for the AI hyperscalers and the large caps, with Europe benefiting from its value composition.
Where's the demand coming from when it comes to earnings here in Europe? If you look at demand, which component part of it is driving it? Because at the moment, it feels like the European consumer is having a fairly tough time. You've got European industrials having kind of a mixed time. What is it like? Where is the growth coming from? Because if we start to get higher energy prices coming back in, does it take away some of that earnings momentum?
Yeah, I definitely don't want to kind of overplay the resilience to the Iran war. There's clearly a lot of headwinds. But if you look at an index like the DAX, for example, DAX has been really solid, quarter to date. It's the best performing European indice. And, part of that is SAP. Looks like it could potentially be turning a bit of a corner.
Yep.
I think you had Anthony on your show earlier saying about how cheaper AI tokens are helping boost software. You've had turnaround in defense sector. Rheinmetall, that's up about 25% from its lows. I think it was June. You've got this multi-year European defence cycle. Then you do also have some attractive names such as Siemens within the index, which is a solid AI infrastructure name. So definitely are pockets, but yes, obviously there are potential headwinds on the horizon.
I mentioned the sell-off in bonds, and we're seeing that again today. If we get a weaker than expected CPI, or maybe in line, 0.1% month on month is the expected increase for US inflation tomorrow. Does that give some reprieve to European bonds? Will it be short-lived? What was the read across potentially from the inflation story in the US?
I think if you look at the price action yesterday and today, I think potentially short-lived is probably more my bias. I mean, I think the reaction function of fixed income traders is different to that of equities. We're still very much at the mercy in the fixed income space of what's going on in the Middle East, and the tenor of news flow is increasingly negative. We saw fresh demands from Trump overnight, hardline adjustments to Iranian personnel over the weekend, and no real evidence of any talks between the US and Iran. So, yes, we might get a short-term jolt higher in fixed income markets, but ultimately we need progress on US and Iran, and that's against the context of the ECB reaction function. We've seen that growth has held up well. Bloomberg survey data, that's been revised higher. And, when things did look a little bit better at Sintra last month, the ECB was still pretty resolute. So even if you do get a bid in fixed income off the back of a soft CPI, I still think European bonds need further progress on US and Iran.
Another big move up in bonds this morning.
Yeah,
big move.
Yeah, gilts selling off.
Gilts are north of 5, 10.
10-year yield up 5 basis points. So again, pressure for the UK Treasury at the very least. Adam Linton from Bloomberg MLIV. Thank you for walking us through some of the key market events. We've got some interesting earnings coming up. The volume story here in Europe isn't telling us much, but CoreWeave and ST Micro on a day when we're supercomputer, I should say, Supermicro. On a day when we're thinking about $500 billion, maybe, of additional capital. We don't know how much of that is new, how much that is reworking some commitments already from Nvidia and team on Wall Street.
More investor money going into the AI trade. The earnings story starts to pick up from now. We've got CPI data coming through as well tomorrow. So quiet start to the week. I think it's going to get a little bit busy. CEO of Uniper is going to be joining the Pulse. That conversation coming up very shortly. Francine Lacroix in charge of the next hour. We'll leave you in her capable hands. This is Bloomberg.